going to talk about accounting for shareholders' equity, which includes contributed capital and earned capital. Contributed capital, also known as the paid-in capital, is the total value of a company's equity purchased by investors directly from the company. In other words, it indicates the total amount of money that the shareholders paid to a company to acquire their stakes in it. While the earned capital is a company net income, which it may elect to retain as retained earnings if it does not issue the money back to investors in the form of dividends. Thus, earned capital is essentially for those earnings retained within an entity. The next one is contributed capital equation, which includes common stock plus capital surplus minus treasury stock. Common stock is the par value of issued shares. Shares entitling their holders to dividends that vary in the amount and may even be missed, depending on the fortunes of the company. While capital surplus or share premium most commonly refers to the surplus resulting after common stock is sold for more than its par value. While the treasury stock, also known as treasury shares or reacquired stock, refers to previously outstanding stock that is bought back from stockholders by the issuing company. The result is the total number of outstanding shares on the open market decreases. The next one is earned capital equation, which includes reinvested earning plus accumulated other comprehensive loss. Reinvested earning, also known as retained earnings, are the cumulative profits of the company that have been retained in the business, are not paid out as dividends. Retained earnings encompass the first three items on the above list. The final item is captured by accumulated other comprehensive income or loss. The picture above is the example of this, of the retained earning equation, which the earning is the net income, distributed earnings, dividends, equals the ending retained earnings. And the last one is more contributed capital, which includes preferred stock and common stock. Preferred stock, as the term implies, preferred stock has the preference or priority over common shares. Specifically, preferred shareholders have priority over common shareholders in the receipt of dividends, and are entitled to receive payments in full if the company liquidates before common shareholders are entitled to any payout. Preferred shares are less risky to the investor than common shares and therefore carry lower expected returns. One common feature of preferred stock is a fixed dividend rate. For example, 6% preferred stock par value 10 peso per share pays an annual dividend equal to 6% of par or 0.60 per share. The fixed dividend is attractive to those who seek stable income from their investments, while the common shares are the basic voting stock issued by corporation because they carry the company's voting power. So it's the common shareholders who we think of when we use the term owners. Common shareholders are the residual claimants on the firm, a term that means that in the event of liquidation, all over the claimants of the firm must be paid in full, or creditor and preferred shareholders, before common shareholders are entitled to any payment. In fact, one way to define ownership is that it represents a residual claim of the firm's assets. When discussing share ownership, Confusion sometimes arises in distinguishing among authorized issued and outstanding shares.
Distinguishing authorized, issued, and outstanding shares. Authorized shares are the maximum number of shares in any given class, common or preferred, that a company can issue. On the other hand, issued shares represent the total number of shares of stock that have been sold or distributed and not yet retired. On the other hand, outstanding shares refer to the total number of shares owned by shareholders on any particular date. It equals the number of shares issued less the number of shares in treasury. Accounting for stock transaction. Accounting for stock transactions includes stock issuances and stock repurchases. The issuance of stock increases both assets and shareholders' equity, but to understand which accounts are affected, the concept of par value must be addressed. Par value is the nominal or state value per share of stock. Share repurchases. For a variety of reasons, businesses buy back their own stock. Possible that the business has extra cash that cannot be invested profitably. Dividends could be paid to investors in place of cash. However, dividends sometimes incur high marginal tax rates. Using buybacks to distribute funds to shareholders may be more tax advantageous. Issuing treasury stock. The corporation indicates its intention to reissue the share by maintaining the share has repurchased and treasury. The shares will be retired otherwise. No gain or loss in record when shares that were previously repurchased are later reissued. Instead, an increase or decrease of additional paid in capital is represented by the discrepancy between the selling proceeds and the treasury stock acquisition price. Issuing treasury stock. The total profit that the corporation has kept throughout time is shown as earned capital. Therefore, earned capital is a result of any activity or event that has an impact of either of those accounts, such as net income or loss, dividends in cash or stock, and any profit or losses that escape the income statement. Earned capital. We now examine the earned capital portion of shareholders' equity. Earned capital represents the cumulative profit that has been retained by the company. For Coca-Cola, it equals the sum of reinvested earnings and accumulated other comprehensive loss. Earned capital is therefore a function of any transaction of circumstance that affects either of those accounts, including net income or loss, cash dividends, stock dividends, and any gains or losses that bypass the income statement. Reinvested earnings are more commonly retained earnings and encompasses the first three items on the above list. The final item is captured by accumulated other comprehensive income or loss. Retained earnings are the link between the income statement and the balance sheet. As seen in Table 16.1, the ending retained earnings, the balance equals the beginning balance, plus the current year's net income or minus net loss. Minus dividends, Coca-Cola pays only cash dividends, but if stock dividends were paid, these two would have to be deducted in order to arrive at the ending balance.
Dividends on common stocks. Investors purchase common stock on the expectation of a competitive return. This return can come in two forms: stock price appreciation and dividends. Some investors prefer to buy stock that little or no dividends because companies that reinvest the majority of their earnings tend to increase their future earning potential. Along with their stock price, wealthy investors in high tax brackets prefer to receive their return in the form of higher stock prices because capital gains may be taxed at a lower rate than dividends income. Other investors, such as retirees who need a steady income, prefer to receive their return in the form of dividends. Such investors tend to seek out stocks that pay high dividends, such as public utilities. Payment of dividends, declaration date, record date, and payment date. Declaration date, October 20, 2016. This is the date on which the Board of Directors officially approves the dividends. Record date, December 1, 2016. This is the date on which the corporation prepared the list current stockholders as shown on this record. Dividends can be paid only to the shareholders who own stock on the date. Payment date, December 15, 2016. The payment date is the date on the cash dividends is paid to the shareholders on record.
To illustrate, we will refer to the final quarterly dividend payment made by Coca-Cola in 2009. Declaration date, October 20 to 2016. This is the date on which the Board of Directors officially approves the dividend because the declaration commits the company to transfer assets. A liability, dividends payable is recognized, therefore the following entry is made: retained earnings and dividends payable. Coca-Cola's dividend payout ratio for 2016 was 92.6%. This figure is high compared to other large publicly traded companies, suggesting that unless Coca-Cola's profitability improves, the company might have to reduce dividends. In some countries, such as the US, dividends are usually paid on a quarterly basis. In other countries, manual payments are more common. In either case, the common stock investor needs to be aware of three distinct dates: the declaration date, the record date, and the payment date. Here's the list of current stockholders as shown on record date, December 1, 2016. This is the date on which the corporation prepares the list of current stockholders as shown on its records. Dividends can be paid only to shareholders who own stock on the date. No journal entry is required. required. Payment date December 15, 2016. The payment date is the date on which a cash dividend is paid to the shareholders of record. The journal entry is dividends payable and cash. Why companies pay dividends is something of a mystery to financial economists, especially when there may be more tax-efficient ways of returning cash to shareholders, such as share buybacks. One popular argument is that dividend policy can be used by managers in possession of superior information about their businesses to signal either beliefs about the company's underlying profitability to the investing community. Not all dividends are paid in cash. Some companies pay dividends in the form of additional shares of stock. Additional shares can be distributed in either of two ways: stock dividends and stock splits. Stock dividends are treated as a reduction in retained earnings and an increase in contributed capital. The amount by which the relevant accounts are affected depends on the proportion of shares distributed to the total outstanding shares on the issue date. If the proportion is less than 20 to 25%, the distribution is deemed to be a small stock dividend. Retained earnings are reduced by the market value of the shares distributed. Common stock is increased by the number of shares times value per share, and additional paid in capital is increased for the balance. For example, if a company issues a 10% stock dividend when its share price is 30 pesos and 50 million shares of stock are outstanding, par value equal 5 pesos, the following entry is made: retained earnings 150 million, common stock 25 million, additional paid in capital 125 million. Retained earnings are charged for the market value of the distributed shares. 5 million shares or 10% of the total times 30 pesos. Common stock is credited for the par value of the shares 5 million times 5 pesos. An additional paid in capital is credited for the balance. In effect, the stock dividend gives each shareholder one additional share for every 10 shares already owned. Proportional ownership is unchanged. Stock splits are proportionate distributions of share and therefore similar in substance to stock dividends. But unlike stock dividends, there are no financial statement effects. Retained earnings and contributed capital accounts such as common stock and additional paid in capital are unaffected. Confusion arises, however, because most stock splits can be viewed as large stock dividends. The distinction that separates a large stock dividend and a stock split is a subtle one, depending largely on local corporate law for the precise treatment. The most common stock split is 2-for-1, meaning that the number of shares held by every shareholder is automatically and instantaneously doubled. For example, if a shareholder held 100 shares before the split, the investor now holds 200 shares.